And here we go again, folks. Welcome to another Profit Strategies podcast. Good afternoon, CJ.
Hey, Tom. How you doing today?
All right, getting ready for another weekend. Got a weekend coming up, and I see a storm that's kind of working itself across the East Coast. And my mother-in-law and my brother-in-law flew to New York this weekend. They've got some things to do up there, masking up. They're N99 masking it up, and they're getting out of town for a little while.
Yeah.
So I got an interesting story I want to share about that with you. We're going to hold on to that for right now. But, it's going to be a quiet weekend.
Quiet weekend because the family's gone? Because the part of the family's gone?
Because a lot of the drama is gone. It's going to be a nice, quiet weekend. Looking forward to it. Anyway, we need to look forward to what's happening in the markets. And before we do that, let's talk about the news that really affected the markets for the week. Yep. And if you could think of one news story that has popped up that you think has affected the markets or maybe kept the markets from doing something you thought they were going to do, what would it be?
Well, I think you'd have to it's a carryover from last week. It's the infrastructure bill. And now everybody's focusing on how it's going to get paid for. And that is the story. And I think the Biden administration kind of blinking a little bit on the 28% corporate tax.
Open to negotiation is what I keep hearing.
That
the
is
other thing, too, is that when you look at that bill, only half of it's really going to what you and I might deem as infrastructure. The other half is going into some other areas that, could be questionable as to whether they truly are infrastructure. But
definitely. Hey. I mean, they're a stretch by many imaginations when you see funding for, some of these social programs.
I think elder care was on there for like 400
social programs. Yeah, exactly.
400 million or billion, or I don't know, the numbers just are absolutely crazy. But, the other thing you got to look at, too, is that this is an interesting one also. Jobless claim numbers rose this week, which I think surprised a lot of people. It surprised the stock market, but the stock market's just been, to me, it's been kind of triangulating into a little bit more and more congestion. We did get new highs again this week in the S&P and, the overall markets. But it just looks like this thing it's getting to the top of a cliff here. And I don't know what else is going to happen in the month of April that could cause the markets to go any higher except for one thing: earnings. And I really think we've got to have some earnings that are just going to smoke it to make this market go higher. Otherwise, we could be in for, to me, when I look at earnings, because I look at patterns, and earnings, the earnings pattern that always seems to come up more often than not is the strong companies come out first, and then the weak stuff gets held into the back half of earnings, which might lead to that sell in May and go away pattern. But it's always what the first week is going to give us. And we are unofficially hitting earnings for the first week next week.
You know what I've noticed here, and I'm sure you've noticed the same thing, Tom, is typically the financials put on a really nice lather of a rally right ahead of earnings. And they've been going sideways. And they've got interest rates that have been a tailwind for them. They've got all kinds of situations. And obviously what's been going on with family offices and liquidations and all of that puts a little bit of a headwind and a cloud or a haze over the financials. And today we saw somebody from the House Finance Committee request information on companies' exposures to not only Credit Suisse, but some of these family offices that have been pulled in. So,
well, I think that's all centered around Bill Wang, and the billionaire one day and not then in 2 days later. He went from 20 billion to nothing in 2 days.
Correct.
I mean that's not. We hear about these pop up every couple of years. You hear somebody who leverages to the hilt in one way or another, doesn't know what kind of trade they're getting into. This guy's a smart guy. Yet, you know what? Greed got the best of it. He got in too deep into one area and it unwound against him. And so, that to me is not a hedge fund. A hedge fund is where you're hedging one instrument against another that's a like instrument. I'm doing it in my account right now. I'm long in certain stocks, and I'm hedging it by being long VIX or long VXX because the two of them almost cannot go they can't go together. If the VIX is going down, the market's going up. So,
Right.
and that's what's happening to me this week. I'm losing on the VIX, but I'm making a lot more on my long bets. All right.
Right.
And I'm going to do the same thing after April, because my VIX trade closes up next week on options expiration, third Friday of April. And I'm going to do it again going in May. I'm going to take a long position in VIX against my long position in the markets. And that to me is a hedge, not leveraging to the hilt and, and really trying to outgun and just out alpha everybody else.
Well, and that's, remember the days of long-term capital management.
Yeah.
Those were hedges. I mean, those were true hedge funds back in the day that blew up. I mean, you had currency hedges that had these six sigma instances, the black swan, that truly rippled around the world and grew into something because they had those chains of hedges that everything blew up at once. I mean, it was
Right, but you could have 100 sigma, and if you're cash secured, you can't go below zero.
That's correct.
Right. So, I mean, at the end of the day, it's all about knowing what you have, knowing what the worst position is going to look like, and making sure you don't go below that.
Yep.
Whatever that number is in your head. And so, anyway,
let's spin off
we're
on the VIX for a
digressing.
second. Let's spin off on the VIX for just a second. Expand on that discussion, because you mentioned hedging away potential volatility with the VIX. VIX making a big move here. If you're a technician, if you watch the VIX, this is kind of striking. But for somebody who's been watching it since 1999, it's kind of a return to norm. We're below 20 now.
Yes.
And I don't think it's coincidentally at the same time that vaccinations are going through the roof, and this idea that the market is going to normalize. Now, of course, Jerome Powell told us earlier this week that the Fed's not done its job in terms of bringing the economy all the way back to an even keel. But the VIX going down below 20 and now even below 18, are we looking at a period where we could see the VIX restate itself as you got to see 10 before you start selling?
Possibly. I mean, I'm long VXX, which is basically short the market,
right,
at 10.5. Actually, not 10.5. When you take out the high probability trade I have, I'm really kind of around 10.10. I'm right there above 10, because that's where I think the stopping point is. And if the stopping point's there, then I break even. If we go below 10.10 by next week, I start losing a little money. But I honestly don't see a 1-to-1 here where I'm going to go 9.5 and I'm going to be down as much as what I think I can be up. And that's the way that I played the VIX.
Yeah.
And so, let's talk about losses, because you and I are not, we don't have a crystal ball. We're not 100% right all the time. No. When I look at some of the stuff in that the only other one that I'm really down on is, I took a position in XLE this week. And XLE looked like, it was going to be a return to normal. We saw the oil market get popped and USO were trading down around 40.
Yep.
And I looked at that in every indicator I have, and I said, you know what? This is a safe place to enter. Well, apparently there could have been a safer place to enter, because I'm down a little on that trade. But this is another one that I've got a little time left to work out on this one. And we'll see where we are next week. So when you and I have the podcast next week, we'll be talking about VXX and XLE and kind of back up and see what ended up happening with those two trades in my portfolio. Everything else is green, and I'm loving that. But I'm always looking. I look at the red on my ledger. I look at the red on my ledger and I say, all right, where am I pulling the plug if I'm wrong? Because to me, that's a real trader that's thinking about not the profits, but trying to cap those losses and keep them as low as possible. And that's what it is that I do. And on the trading side, grind it out, grind, look for and spot those opportunities and create those alternative risk trades. And then, you know what? The boring part: plan, execute, and manage. And manage is what I do. And I look at this stuff all the time, probably too much. But maybe too much is not enough. So anyway, Chris, I lost your feed there, buddy. I can't hear you. Maybe hit the mute button by accident.
Sorry about that.
There you are. So let me let's move to a new subject. and that is, we're now entering, as of next week, the third week of April, the third Friday of April. We're going to be literally halfway through the month before you know it. Back half of April, I still see a little bit of green on the screen, but it's going to start to turn orange. It's going to start to turn, and it seems that's exactly what the market seems to be dictating as these highs are getting lower and lower, and we start to crest over. Is there a concern? It can't be a tax concern because tax day has been pushed to May 15th now here in the U.S. So we can't look at April 15th as the sell date, but I still, there's a lot of variables here. I look at patterns. Patterns tell me that April's the best month to be long the market, but we're already going to be halfway through the month here soon, and so that time's going to be running out. Do we sell in May and go away? But then there's a situation where there's a lot of cash that is still sitting on the sidelines, and I gotta say, I've been talking to some young people out there, all right, that are friends with my son and daughter. And I am absolutely amazed at how some of these people are actually saving money and saving good bits of money and are asking, well, how do I invest this money? And, I'm not an investment advisor. And I have to tell them that straight off. But then when they tell me how much money they have sitting in a savings account earning a little bit more than 0%, at first I was impressed. I'm like, well, you have what? And then the second thing I said was, wow, why are you keeping it all in savings? I said, you're in your 20s. You've got 4 decades of 3 to 4 decades where you need to be thinking about growth, growth, growth. And the next question is, well, what if it goes down? I said, in 40 years, that's never happened.
No, it's going to go down in a period, but yeah, over a 40-year period, no way.
Yeah. But then, a lot of folks they're nervous about the stock market. They're hoarding a lot of their money in cash.
Mm-hmm.
Now I'll tell you a little funny story about my mother-in-law. My mother-in-law, we always, when she flies, which she hasn't flown in over a year. So she ends up first taking bags out, and she's got all these bags. She's going away for a long weekend. She looks like she's going away for 6 months. So we have to go through the bag police have to come in and go, okay, you can't take that. That's a liquid. You can't put bottles of water in your bag. She's an old school Italian, that goes all the way back to World War II and she still thinks in those days, well, what if something happens? What if this, what if that? So, she's got food in her bags. No, you can't take that. The dogs are going to sniff that out as soon as you land.
Yep.
You can't take food. You can't take water. You can't take all these baggies with all your stuff in it. So my wife's digging through some of her stuff, and she pulls out this wad of cash that no one knew she had. And so she's got it. I wander, I go in the bedroom at her house, and my wife's got all this cash, and it looks like, I'm like, what's going on in here? She says, "You guys, all this cash." She goes, "No, it's my cash." And he goes, "Where did you get this? Because you don't go to the bank." "I've had it for 10 years. I mean, she literally has been hanging on to this, and we just didn't even know. But, the thing is that represents security to her, that wad of cash.
Mm-hmm.
And it made me start thinking that the same thing is true with a lot of millennials. A lot of millennials and a lot of the Gen Y folks. You've got some of them out there. You got one side that's gambling their money on Wall Street bets. And you've got the other ones that are saving and scrimping, and the only thing they know is a savings account or sticking it in the ground or shoving it in their mattress. And so that little incident made me think about the millennials, the Gen Ys that don't trust the stock market, and they, and this is a group where a lot of them aren't even having kids and aren't even thinking about having children. They're saving their money. The problem is that we're in a situation right now, and this is what I'm trying to tell people. We're in a situation right now where the U.S. dollar is 10% lower than it was last year. You have 10% less buying power than you did this time last year. When do you think that's actually going to reverse? It might on the short term, but the way things are going, that dollar is going to get less and less and less. And if you just shove it in the bank or you shove it under your mattress or in a hole in the ground, you're going to be amazed at how little that spending power is going to be 10, 20, 30 years from now.
Well, you're losing money safely, right?
Yeah. Exactly. You're losing money slowly. It's like death by a thousand cuts.
Yep.
And so, I throw that out there. At the same time, I'm thinking that there's all this cash building up, sitting on the sidelines. Eventually, there's going to be, because we know how humans are, there's going to be a pent up demand to put that to work somewhere. Where does it go? Well, people are watching the real estate market right now. And
Hmm.
I don't know if it's happening in Cincinnati, but I've never in my life seen a situation where in Florida, of all places, you set the price, and now they're being overbid. Their bids are coming in, and they're going higher and higher. And what's happening is we're seeing corporations come and buying houses sight unseen, because the corporations 10 years ago who bailed out, who were told by the government to come in and buy property and keep it propped up and bail out, they found a whole new investment idea. Let's
Yeah.
just start getting into the property management. We're going to buy properties sight unseen, fix them up a little bit, and then rent them out. And so that's part of what's causing the real estate market to jump. So here's these millennials and Gen Ys who thought they were saving up for a house that now they can't afford because, again, the dollar is dropping compared to goods and services. So can't put your money there. But the thing is that you have to put your money somewhere long term. And we got off the trading kick for a minute, and I apologize to those of you who are here to talk about 30 days or less. But every once in a while, we got to talk about greater than 30 days.
Yeah. It's interesting also, Tom, when you talk about and I'm just going off on a side note here, housing. And you said with the existing houses there aren't any houses being built right now, or at least they've slowed down because of the cost of materials, right?
And the lack of supply.
Yeah. I mean, it is. I heard a story the other day from a builder about a 4x8 sheet of OSB selling for upwards of $30. It's a seven
Yeah,
dollar sheet of wood, and not even wood,
exactly.
particle board. So a lot going back to what you said about people setting their price right now and getting outbid. That is happening here in Cincinnati. It's happening in full force in a matter of hours, not days. If you have a
Yeah.
house that is in good shape and you want to get rid of it, boom, it's gone. Doesn't matter whether it's a company or people that are just looking to get into those houses. How long
And
does that last? And there's
and
my
what's
question.
happening too is that a lot of these houses don't even get on Zillow or
No.
realtor.com. That before they even go out, somebody's already going and knocking on doors and saying, "Hey, I'll pay X for your house. Keep it off the market," because they don't want to get into a bidding war
Yep.
with a bunch of retail clients.
Yep.
So,
This is
I
where a
mean,
realtor earns our money in this type of a market.
it
Knowing
really
what's
is. Me, God, you know what? I tell you what, I hate getting old. It hurts. Yesterday I did a lot of physical stuff, and I'm like,
Mhm.
my body was killing me. But I got to tell you, wisdom is just. Sometimes I just think about experience and wisdom and how much I gain from that, even though I lose it here in the shoulders and the arms and the legs. But I'm getting it up here, and thank God I'm getting something for losing my ability to run and climb and you know. But anyway, where I'm going is this: is that you look at what you and I have seen, and I start thinking with my investing brain. I'm thinking, all right, Bill Gates is buying up a lot of farmland. All right, he's not doing it because he wants to be the largest farmer in the world. He sees something on the agriculture side. I'm seeing the same building material stuff, and I'm thinking tree farms. That might be, this is how far, my head goes back into where is the initial, and we own a couple farms, and they're not in the U.S. Because farming in the U.S. is a little tougher than farming in Central America because of all the laws and regulations.
regulations. Yeah.
But tree farms, that might be something that to look into. But I mean, on the public sector, when you look at the real estate market and you look at these commodity based, I call them ETCs, exchange traded commodities.
Mhm.
You know, I don't know about you, but I see a lot of this stuff might get a little volatile, but I still think higher highs and higher lows on the horizon for the coming years.
You know what I just pulled up, and it's ironic that you bring up the agriculture, or I'm sorry, the commodity based, the DBA,
Yeah,
which is the Invesco Agriculture.
used to
It's
be
not an
called the
ETF
Deutsche
per
Bank
se.
Agriculture, the
Yep, yep,
DB.
yep. So that is actually just completing a little bit of a touch and go on its 20 and 50-day moving average. That is one that is up year to date 6%. I mean, it's respectable, 22% for the last year. I mean, this
Yeah,
is an area of the market that's going to give you slow burn, consistent
exactly.
growth.
We're not
And so,
talking technology here. We're not talking social media. We're talking food. We're talking
food.
about something that is in demand and will continue to go in demand if you just look at, I mean, I think everybody can kind of agree on this, whether you're on the left side of the argument or the right side of the argument. If you're climate change, then you're going to say, oh yeah, definitely food prices are going up because
Oh,
climate
yeah.
change is going to affect agriculture. If you're in the what we call the Dust Bowl region of the country, you know that the ground isn't as fertile as it used to be. It takes longer to grow things. We're doing synthetically grown food, created food now too. But yeah, slow and steady wins the race for companies and products like DBA. And DBA is a great way to get involved in agriculture without owning a farm.
Yep, absolutely. And, maybe sidle up next to Bill Gates a little bit on that one.
That's right. That's
He
right.
is the largest farm owner in the United States now.
He is. And,
Yes.
and the other thing too is that and I look around for opportunities like this outside of the markets, and it's getting harder and harder to find this stuff, especially when COVID first came out. All of a sudden, everything was on sale for a couple of months, and
Yep.
then it was gone just like that. And now I see very little. In fact, when looking at land prices and land in Florida, even Central Florida, everybody seems to laugh and go, "Oh yeah, you're buying swampland." Even swampland is hard to find these
Yeah.
days. So, anyway, last subject of the podcast, Chris, and you brought it up, so I'm going to push it to you first, and that is indicators. And you said, let's talk about our three favorite indicators that we can't do without. And we're talking about indicators that literally anyone can get, not
Yep.
proprietary indicators. So, you take it first.
So this is very easy. And one of them even includes the same indicator, Tom. And we're talking about indicators on stocks. So those three things, I call them my island indicators usually. If I can't see anything else, if you give me these three things, I'm going to say buy, sell, hold. First one is the 50-day moving average, and two things about it. The 50-day moving average, and let me give you a little history here. 20 years ago, sat down with my database, my newly made database, all shiny and packed with data, right? And I decided I was going to go and look at the S&P 500 companies. There were 502 at that point because you have some A and C share type of situations.
Mm-hmm.
So went through each one of them, had the 50-day calculated, and all I said is, what happens to the stock when the 50-day is moving higher? I don't know if you know this, but you've got a 2 to 3 chance the next day that the stock is going to close higher than it is today. Just if the 50-day moving average is moving higher, nothing else. So you get up into the 60% range, 65, 66% range, that stock XYZ is going to be higher the next day. That's the first thing that I always look at. You've quantified the trend is your friend, and there's no more followed rule out there than the trend is your friend. Nobody knows really how to say, well, what is it? That's it. So that's number one, Tom. Number two is whether the stock's trading above or below that same exact trend line. If it's dipped below, then it tells me I'm in a transition, and you can say, well, I may want to hold back on this, wait until I get it to come back. Number three, RSI. I want to know how far, how fast that stock has gone. There's no better way than looking at, you can look at the 14-day, I look at the 20-day because I'm tuned into just what's happened over the last month, 20 to 21 trading days in a month. I look at the 20-day RSI. And we've all heard that, it's run its course. It's the rubber band. We talked about the slingshot a couple weeks ago with GBTC. And, that is the thing that tells me, am I getting into the stock at the right moment? Not the right time. The time is at 50-day, at the right moment in time.
Yeah.
Those three are gold to me, and they are the first thing that I look at on any stock. I don't care if it's trading at 20 cents, $20, or $2,000. First three
Okay.
things.
Here's my three. So I like moving averages too. I'm more a person who looks at a moving average crossover as a trend indicator. I like the 1030. There's no secret to that. That's something that my predecessor, George Fontenilles, used to look at all the time.
Mm-hmm.
And no matter whether, when we taught live seminars, and I have to think way back when we actually taught live in-person seminars, But it didn't matter whether it was a basic seminar, more advanced seminar, or to our elite partners.
Mm-hmm.
He was always bringing up that 1030 moving average as part of that, whether that was a 1 day, 2 day, or we did 1 week seminars where we'd bring people into the Ritz or a really nice place, and we just teach and trade all week long. He'd always bring up that 1030, and it was a good indicator. And so I like that when the 10 period crosses above the 30, it just gives you a trend up pattern. 10 crosses below the 30, trend down pattern. And it's a trading pattern. It's not an investing pattern. You know, the 5200 are really more used for investors.
Yep.
Golden cross,
golden death,
or the death cross. This is more of you taking a look at 1030. This is what happens in between earnings. And I think this is a great little less than 3 month indicator. The second thing, and I look at on my screen, and this is what I call the pullback indicator, and it's Fibonacci ratios. So I like to snap between a low and a high, a fib ratio. And then to me, most indicators out there that people look at are what's called lagging indicators. That means you need a lot of data for the indicator to catch up and give a signal. And even though Fibonacci, you have to use a low point and a high point, I like to call that a forward-looking indicator. Because where the market is now, you could forward look to buy zones in the future with pullbacks. You could forward look even to the future with extensions, if you understand Fibonacci well enough, where a target could be. So that's why I like the Fibonacci itself. It really is the forward-looking indicator using time points, high and low points from the past. And then finally, as an option trader, I got to say, implied volatility. This one is not as easy to get. There are places you can find this that are out there. And a lot of brokerage firms do have their own IV numbers if they have options as part of their platform. So I like charting implied volatility and getting an idea of whether the option prices are hot or cold. And by cold, I mean cheap, where they could become buying opportunities. So, for instance, let's just say that I get a buy point. And I did. Did we talk about Chipotle Mexican Grill last week?
No, we did not.
I don't remember, but that was on my radar. I've had so many webinars this week. We were talking about it, and that's one of my longs. And talk about slingshot and gauge. This thing took off this week. And part of what I was looking at was that 1030 cross. But the other thing I'm looking at as an option trader is what is the best option to take? And I call it surfing the red wave. And the red wave is a term we use for implied volatility. If the IV is low, I'm going to be a buyer of options. If the IV is high, then I'm going to surf the sell side and I'm going to sell premium. And so I use that red wave, that red line of implied volatility to give me a quick idea of whether I want to be long time premium or short time premium. So those three: moving average cross, Fibonacci, and IV.
Hey, when you let me dig on that IV for a second. When you're looking at the IV of the option, are you doing like your own little VIX? Because I've done that in the past and calculate that in the database where I use synthetic at the money.
All right. So shameless plug for tomsoptiontools.com. I got to throw it out there. What we do is we take the near money calls and puts, all right, and we timestamp those, and we're able to go back for years and look at we timestamp that IV each day, and we connect it like a chart, and we're able to stretch that thing out over 1 or 2 years and get an idea of where was it on its low side, where was it on its high side, and where is it right now. So we use the 1 to 2 year history to determine when that option was cheap and when the option is expensive. Now, we do it on every individual stock because you can look at the VIX, but the VIX is an average of 500 stocks in the S&P, where I want to look at the actual stocks implied volatility, and I want to see that chart of each one. And then from there, again, I'm able to determine if it's cheap or expensive. Now, you can also see the whys. Oh, why was it up here? Oh, that was because an earnings report came out just soon after. Why did it drop down? It could be after the earnings. But when you smooth those out and you start looking at them, you can see highs and lows. And I find as a trader, it's much easier to predict implied volatility based on patterns than it is actual stock price.
Sure.
So that's what I use.
Love it. Love it.
All right. Well, Chris, Thanks for joining us on another weekend or another Profit Strategy podcast as we enter the weekend. So we'll be back next week. Third Friday of April's coming up. Folks, we'll have a brand new show there, and we'll talk about the VIX, and we'll talk about the other mistake. I call it a mistake, XLE, but we'll see what ends up happening when, one day or even 1 week doesn't make a trade when it's on for a few weeks to 30 days.
Correct.
We'll see what ends up happening. I may end up rolling those forward. We'll talk about that as we head into next weekend. Hey, thanks again for watching the video. 3 things for you. Number 1, for more information on how we trade like rules-based traders, check out the description below this video. I've got a lot of free stuff there for you. Number 2, like this video, please. It helps support the channel. And finally, if you subscribe to the video and ding the button next to it, you'll get the next one as soon as it's uploaded. Thanks again. We'll see you on the next video.